So it looks like your lecturer really wants you to do well on that Unilag exam next month. They sent over some awesome resources for you to study. And one of them is this Investopedia article. It's called Interest Rates, Different Types and What They Mean to Borrowers. That's what we're going to be diving into today, gotta say. Just reading through it, I learned a lot. For example, I always knew that interest rates mattered, but I never thought of it like this before. Interest is like the cost of money. It's kind of like a rental fee when you're using someone else's cash. And then there's this whole thing about compound interest. It can really add up, especially when you think about things like mortgages. But luckily, we've got our financial expert here today to break it all down in a way that I think even I can understand. So maybe we should just start with the basics. What exactly is an interest rate? I feel like we hear that term all the time, but we don't really know what it means.
Yeah, you're right. It is one of those terms that gets thrown around a lot. In the simplest terms, an interest rate is the percentage that you pay to borrow money, or the
Right.
percentage that you earn when you lend money. So think of it like this. When you take out a loan, you're essentially renting money. And that interest rate, that's your rental fee.
That's a great analogy. So if I take out, let's say, a $300,000 loan for a house at a 4% interest rate,
Yeah.
like the example in the article, that 4%, is that how much extra I'm going to end up paying back over the life of the loan?
Yeah. But you have to remember, there are different ways to actually calculate interest, and that can have a big impact on how much you ultimately pay back. That example that you just gave uses what we call simple interest, and that's calculated only on the principal amount that you borrowed.
So with simple interest, is it really as easy as just multiplying the principal?
Yeah.
By the interest rate and the number of years?
Yeah, exactly. So in that example, if it were a one-year loan, you would just multiply that $300,000 by 4%, and that would give you $12,000 in interest. But most loans, especially things like mortgages, are paid back over many years.
Yeah.
So that simple interest, it really starts to accumulate.
Okay, that makes sense. But then the article goes on to talk about compound interest, and that's where I think things started to feel a little bit mind-boggling for me.
Yeah, it can be. It can be tricky to wrap your head around at first. Compound interest is basically interest on interest. So you're earning interest not only on your original principal, but also on any interest that you've already earned. It kind of has like this snowball effect that can make your money grow a lot faster over time, or cost you a lot more if you're the one borrowing. Remember Ben's $10,000 loan example in the article? That really shows how compound interest can add up.
Oh yeah, that example.
Yeah.
That one made me want to pay off all my debts right away. Thinking about this in terms of my Unilag exam, I know we need to understand the difference between APR and APY. The article touched on that a little bit, but I still get them confused.
Yeah, it's an important distinction, especially when you're comparing things like loan offers or savings accounts. APR stands for annual percentage rate, and that's typically used for loans like credit cards, and it doesn't include the effects of compounding. But ATY, that stands for annual percentage yield. That one does take compounding into account, so it gives you a much more accurate picture of how much interest you're actually going to earn on things like savings accounts or CDs.
So if I'm trying to maximize my savings, I should look for a high APY. But if I'm taking out a loan, I want a low APR.
You got it. Now, this might not be on your exam, but it's worth knowing. Interest rates don't just magically appear. There are a lot of factors that influence them, particularly a country's central bank. Like in the U.S., that's the Federal Reserve. They played a really big role in setting interest rates.
That's the Fed that we hear about all the time on the news, right?
Yeah.
But why would they want to change interest rates? What's the point of that?
Well, they have a lot of power to influence the economy by adjusting those interest rates. One reason they do this is to try to control inflation. You know how fast prices are rising?
So if prices are going up too fast, they might raise interest rates. Wouldn't that make things even more expensive, though?
This seems kind of counterintuitive, but it actually works by making it more expensive to borrow money. So when interest rates are higher, people and businesses tend to borrow less, and that can slow down spending, which helps to curb inflation. Of course, it's a delicate balance because higher rates can also slow down economic growth.
Okay, so that's starting to make sense. So if the economy is kind of sluggish, the Fed might lower interest rates to encourage people to borrow and spend more.
Exactly. Lower interest rates can make it more attractive for businesses to invest and expand, and for individuals to take out loans for things like homes or cars. And that increased activity can stimulate economic growth. So it's kind of like they're riding a seesaw, trying to find that sweet spot between controlling inflation and keeping the economy moving.
Yeah, it really is a balancing act. And speaking of balance, that reminds me, The article also touched on the idea of racial bias in interest rates, especially when it comes to mortgages.
Yeah, that part was concerning. It mentioned that people of color might be offered higher interest rates than white borrowers, even if they have similar financial situations.
Right, and it's a complex issue. There are a lot of different factors at play. Some researchers argue that it's a reflection of systemic biases in the financial system, while others point to things like SIAs, differences in credit scores, or the types of loans that people are choosing. So it's a debate that's still ongoing, and it's important to be aware of those different perspectives. And the potential for unfairness there, definitely something to keep in mind as we learn more about interest rates. Okay, so we've talked about what interest rates are, how they're calculated, simple versus compound. Yikes. And some of the factors that influence them, like central bank policies. But why should we care? What does this all mean for us, especially with that UNILAG exam coming up?
Well, for starters, understanding interest rates is crucial for making smart financial decisions, both now and in the future. Whether you're taking out student loans, saving up for a big purchase, or investing for retirement, interest rates are going to play a major role in how your money grows or shrinks over time.
I'm starting to see that. Thinking back to that cost of money idea, knowing how interest works can help me avoid paying way more than I need to on loans.
Yeah, absolutely. Plus, understanding how interest rates are influenced by things like inflation and central bank decisions can help you make more informed choices about where to put your money. For example, if you know that interest rates are likely to rise, you might want to lock in a fixed rate loan now before those rates go up.
That's a good point. It's like having a sneak peek into the future of your finances. Speaking of the future, I know the exam is probably going to cover different types of interest rates, not just simple and compound. Can you give us a quick rundown of those?
Of course. In addition to simple and compound, you'll likely encounter terms like fixed interest rates and variable interest rates. With a fixed rate, the interest rate stays the same over the entire term of the loan, which can be really helpful for budgeting because you know exactly what your payments are going to be. Variable rates, on the other hand, can fluctuate based on market conditions, which means your payments could go up or down over time.
So fixed rates offer stability, but variable rates could potentially save you money if interest rates go down. It sounds like there's always a trade-off.
There is, and that's why it's so important to carefully consider your individual circumstances and your risk tolerance. When you're choosing between different loan options.
Okay, this is all making a lot more sense now. I feel like I'm starting to connect the dots between interest rates, loans, savings, even the overall economy. But I have to admit, the article's explanation of how the Federal Reserve sets interest rates kind of lost me. Can you try to explain that in a simpler way?
Sure. The Fed uses a few different tools to influence interest rates, but the one that they talk about most is the federal funds rate. Basically, this is the interest rate that banks charge each other for very short-term loans, like overnight loans.
Okay, so it's like a bank-to-bank lending rate, but how does that affect me?
It has a ripple effect. Throughout the entire financial system, when the Fed raises the federal funds rate, banks have to pay more to borrow money from each other, so they pass those costs along to their customers by charging higher interest rates on loans and mortgages. And the opposite happens. When the Fed lowers the rate, it becomes cheaper for banks to borrow, so they can offer lower rates to their customers.
So the Fed's actions with this federal funds rate can make it either more or less expensive for me to borrow money for things like a car or a house.
Precisely. And their decisions about interest rates are influenced by a lot of different things, including inflation, unemployment rates, overall economic growth. They're constantly trying to find that sweet spot to keep the economy stable and growing.
Wow, it's kind of amazing how much power the Fed has to impact the economy just by adjusting this one interest rate.
It's a big responsibility, and their decisions have far-reaching consequences.
I'm starting to get a sense of that. Now, going back to inflation for a minute, the article mentioned that it can erode the purchasing power of money. What does that even mean?
Think of it this way. If you have $100 today and inflation is 5%, next year, that same $100 will only buy you what $95 would buy today. Your money's value has essentially decreased because prices have gone up.
So inflation makes my money worth less over time. That's not good.
Right. And that's why central banks try to keep inflation under control. One way they do this is by raising interest rates, like we discussed earlier. Higher interest rates can slow down spending, which can help to curb inflation.
Okay, I'm seeing how it all ties together now. Inflation, interest rates, central bank policies, it's all interconnected. But I have to ask, is there ever a time when low interest rates are a bad thing.
There can be. While low rates generally stimulate borrowing and economic activity, if rates stay too low for too long, it can create things like asset bubbles, like in the housing market. It can also make it harder for savers to earn a decent return on their money.
So it's all about finding that balance, just like the Fed tries to do with the economy. I'm starting to feel a lot more confident about this interest rate stuff,
Really?
which is a good thing, since that UNILAG exam is coming up fast.
I'm glad to hear that. And remember, if you want to dive a little deeper into some of these concepts, the eLearning Tutor YouTube channel has some great visual explanations that might be helpful.
Oh yeah, that's a great resource.
It really is. And as you continue studying, remember that understanding interest rates isn't just about passing an exam. It's about equipping yourself with the knowledge to make smart financial decisions throughout your life.
Well said. It's like we're getting a crash course in financial history here. I never thought about looking at interest rates that way.
Yeah, it can be really eye-opening. You start to see these patterns and how different events like wars, recessions, even technological advancements can cause these major shifts in interest rates.
That's fascinating. It makes me realize there's so much more to learn about this than what's even going to be on the exam.
There always is. But the great thing is, this knowledge, it can really help you. Beyond just acing a test, understanding interest rates can really empower you to make smarter choices about your money throughout your life.
Yeah, that's what I'm starting to realize. It's not just about memorizing definitions. For the UNILAG exam, it's about actually being able to apply this stuff to real-world situations.
Exactly. Imagine you're graduating soon and you need a loan to buy a car. Understanding the difference between fixed and variable interest rates and how those rates might change in the future could save you thousands of naira over the life of the loan.
Okay, yeah, now I see how this is actually practical. And speaking of practical, I remember the article mentioned something about how the Federal Reserve's decisions on interest rates can even influence things like the stock market.
Oh, absolutely. When interest rates are low, it often makes borrowing cheaper for companies, which can boost their profits and make their stocks more attractive to investors. But then on the flip side, when interest rates rise, that can sometimes lead to a decline in stock prices.
Wow, it's all connected. So basically, even if I'm not directly borrowing money or investing in bonds, changes in interest rates can still affect my financial well-being.
That's a great takeaway. Interest rates are such a fundamental part of our economic system, and understanding how they work is key to making informed decisions.
I bet your money. I like to say, this deep dive has been incredibly eye-opening. I feel like I've gained a whole new perspective on interest rates. And I'm definitely more prepared for that UNILAG exam next month.
I'm glad to hear that. And remember, if you need a visual refresher on any of the concepts we talked about today, the eLearning Tutor YouTube channel is a fantastic resource.
Oh, yeah. I highly suggest checking it out. It's helped me.
Awesome. Learning is a journey. And the more you explore the world of finance, the better equipped you'll be to make those smart decisions about your money.
Couldn't have said it better myself. So for those of you listening, keep diving deep, keep asking questions, and best of luck in your exams.
Yes, and remember, even after that exam is over, this knowledge, it'll continue to serve you well throughout your life. Understanding interest rates is an investment that pays dividends for years to come.
So true. All right, that's a wrap for us today. Until next time, keep those brains engaged and those wallets happy.